Hello there. My name is Eric Diaz, and this is my partner, Jenny Espino. And we did our financial analysis report on Home Depot and Lowe's. Okay, so now the question is for Lowe's, who are the shareholders? So there's 10 main institutions that hold the majority of the shares. One of them being Vanguard Group, um, Columbia Management Investments, J.P. Morgan and Chase, Northern Trust Investments, BlackRock Fund Advisors, and several more. Overall, there's about 610 million shares held amongst them. So that would be around 73.52% percent held by institutions alone for Lowe's.
So, for Home Depot, the top institutional holders are Vanguard Group Inc., BlackRock Inc., Capital World Investors, State Street Corporation, FMR LLC, Bank of America Corporation, JP Morgan Chase and Company, Capital Research Global Investors, Northern Trust Corporation, Price Associates Inc. And one thing to notice is that some of these institutional holders are also the same as Lowe's. And currently, for Home Depot, they have 831.4 million shares outstanding. 72% of those shares are actually from the institutions.
So another thing to cover is why do investors care about the cost of capital? Now there are some advantages to cost of capital, such as it is used to maximize the value of a firm, and it also gives the ability to receive higher returns as well. Um, and the major concern is always a risk of failure. So it's important to investors. They look at the cost of capital because it can either increase or decrease the value of the firm overall. So it is something very essential to look at, very vital, I would say.
And there is also two methods of actually being finding out the cost of capital, and that's through equity and debt. So the next topic we're going to be discussing is the cost of debt financing. This is an important measure because it can give investors an idea as to how risky a company is compared to others. Typically, the riskier companies have a higher cost of debt. So there's two cost of debt measures. One is the pre-tax and the other is the after-tax. Usually they state on a after-tax basis because interest on a debt is tax deductible and it reduces a firm's taxable income. So for cost of debt pre-tax, it can be found by adding the default spread to the risk-free rate. This percentage shows the amount of interest paid on a loan without taking the taxes into consideration. Both Home Depot and Lowe's are rated at an A2A rating, and they both have a cost of debt pre-tax of 4.54%. And now for cost of debt after tax, it is actually calculated by subtracting the company's effective tax rate by the one and then multiplying the difference by its pre-tax cost of debt. So for Home Depot, its after-tax cost of debt would be 3.45%, and Lowe's after-tax cost of debt is 3.59%. So our next topic is cost of equity financing, and this is the other measure used to figure out our cost of capital. So we were able to calculate our cost of equity financing by using the capital asset pricing model, also known as CAPM. And on our following slide, you can see the formula on there. Home Depot currently has beta of 1.1.
1.1104.
And Lowe's also has the beta of
1.1354. So for the overall cost of capital, we look at the market capitalization and as well as the company financial statements. So we look at both Home Depot and Lowe's. The total number of shares for Lowe's is 610 million, and for Home Depot is a lot more with 831 million shares. The market cap is a lot less for Lowe's at 79.1 billion, and the market cap for Home Depot is 204. I'm sorry, 214 billion. So significant difference between the two. The market value of debt for Lowe's is 14, while it being 22 for Home Depot, and the market value of equity is 79 billion, while Home Depot is a lot more with 214. And the debt ratio for Lowe's is 0.15 and 0.09 for Home Depot. And another thing that we look at is the cost of capital. Cost of debt for Lowe's is 4.52 and 3.45 for Home Depot. Cost of equity is 11.32 for Lowe's and 9.61 for Home Depot. And the WACC is 9.79 and 8.64 for Home Depot. So, very sort of close, but there is a difference between the two.
And then the question is, does more debt actually mean more unnecessary risk? Well, after analyzing both companies, we can see that by increasing debt, it can indeed increase the value of both of our companies. However, by increasing the debt to our optimal levels for both companies, debt to optimal would have a huge debt increase for very little firm value gain. So therefore, it would not be worth the increase in debt because it would cause limitations on the company's financial projects or future decisions. So how would financial restructuring affect the value of the company? So for Lowe's, if we were to increase the debt to equity to our optimal percentage, which is 40%, this can give us an increase in our firm value for 104.294, and it can give us a net gain of 4.634, and this is in billions. And for Home Depot as well, if we were to increase our debt to equity up to our optimal level, it would go up to 40%, and this can increase our firm value of 187.108 and give us a net gain of 7.933.
So for Home Depot, in our stock analysis, we valued the stock at $184.12. The most recent closing of the stock was $183.73. So this indicates that Home Depot is slightly overvalued. For Lowe's, the most recent stock price was $96.39. In our analysis, the stock was valued at 97. So Lowe's is slightly overvalued as a stock. So that's our video. Thank you for watching, and I hope you have a great day.